Well, good morning and welcome to another episode of CREDE Real Estate Play Offense. Today, I'm very happy to welcome my dear friend Shlomi Ronen of Dekel Capital to talk to us a little bit about not only his background and what he's seeing in the debt and equity markets, but also a little bit of his story and what he's seeing in the ever-changing market of debt and equity placement. As a lot of us think we can do it ourselves, but as we continue to find, it's always great working with professionals. So, Shlomi, welcome, and thank you for joining us today.
Thanks for having me. Happy to be on the show.
Of course. So we've known each other for some years now, but as a starting point, maybe tell the listeners a little bit about not just Dekel, but yourself and how you got started in this crazy business and why you decided to start your own company and kind of what your niche is.
Sure. So the backstory on myself is graduated with an engineering degree in civil engineering and went straight into construction management and worked in construction management for 5 years, building commercial buildings for both international and regional general contractors, and was sitting across the table from a lot of developers and finance folks, and kind of came to the realization that I really wanted to be on the other side of the table. And so it prompted me to go back to school, got my MBA from USC, focused on real estate finance, and used that as a platform to career change essentially and get into the finance side. Started working at a regional shop in LA called George Smith Partners that were really structured finance experts, and got to work and be mentored by some of the best in the business, and was there for 8 years. And over those 8 years, developed the skills and as George used to say, the art of the business, because there's the function of getting a name and putting a package together and sending it out. And there's also the art of the relationship and understanding the people and really being able to put everything together to get to a closing table at the end of the day. So learned the art of the business there. And when the market took a big correction during the Great Recession, we kind of I thought it was time to pivot and saw an opportunity to get into note sales. So left George Smith Partners with a couple of my colleagues. We opened an office for a New York-based firm that was predominantly focused on note sales and equity raising. And that really gave me a greater appreciation and greater exposure to the distressed world, as well as a lot more equity raising and the skills and the relationships there on the equity raising world. And really solidified kind of the premise that I had, which was, ultimately we need to be really good at raising equity for our clients, and in order to get the debt business. And the debt business in normal times is somewhat of a commodity business. So the value add was helping our clients grow and really being able to also be that reliable source where a client can know that they've got us out there looking and focusing on them. So that I'd say in terms of a differentiator, in kind of our platform, we're definitely a lot more client focused and sponsor focused than the vast majority of the finance shops out there, which are really transaction and deal focused. So that kind of led to, as partnerships go, I had good partners, but ultimately we realized that we had different vision for the future. We split up in August of 2011. I literally called one of my clients and said on a Friday and told him, Monday morning I'm showing up at his office and taking one of his empty cubicles. And that's how Dekel Capital started. So we're actually 13 years almost. In about a month, it'll be 13 years that the company's been around, and we've since kind of grown it and morphed it into really a mortgage banking firm, which is also a little bit of a differentiator for us, where we've got proprietary equity, we've got correspondent lending, as well as our investment banking capabilities of going out and raising third-party debt and equity for investors and developers.
And that, it's interesting. We work together with some of our clients, and I echo what you say. I mean, I think being able to find our clients, equity for ground up projects in Mexico, as an example, with family offices and small banks. I've never exactly thrown you the layup, but
No.
You've been able to pull it off. And so maybe talk a little bit, if you were to, I can say, having worked with you, it's like, oh well, there is a niche, which is that the equity side, and you're right, the debt historically is that commodity, but you add that where you can place your own debt, you can do different things. What's for people that are out there, what's your ideal client or ideal project that you're looking for that's, in today's market, that your equity wants to be attracted to, or that you want to?
Yeah, look, we in terms of a client focus, we're squarely focused on the middle markets, and I'll define the middle markets as deal sizes ranging from $30 to $100 million plus. I'd say the vast majority of the projects we work on, we're raising somewhere in the neighborhood of $50 to $70 million of capital. That's in the form of usually equity and debt, and sometimes subordinated mezzanine or pref alongside it. And clientele, it's entrepreneurial groups. So it ranges from established companies that are national, that have teams, like a local regional team that's looking to grow in a certain region, and they're kind of tasked with finding the capital as well. There's no central capital raising arm to the business, or quite frankly, a team that's generally 5 people kind of out focusing on regional deals and entrepreneurial and looking to grow. I find that ultimately, our clients really make money on finding deals and executing on deals, and capital is really just a necessary, I wouldn't say necessary evil, but it's kind of like the blood that runs through the whole system. So if we can bring that to the table, and they can rely on us to help them there and understand what they're doing and where they're going, then they can spend more of their times doing the things that really ultimately make them money.
It's interesting. A year and a half ago, as the world changed and kind of the worm turned with interest rates, we started from our side seeing a lot of institutional capital move the goalposts. Not unexpectedly so, because in the equity side of the business, it's about predictability. It's about looking
Right.
at your funds or looking at your allocations. Are you continuing to see that? And I ask that because I'm starting to hear a lot of our institutional clients that manage their money to say, oh, well, we're ready to get back in as soon as we see we can buy a 25 or 50 basis point swap, or debt comes down just a little bit. It feels like the goalposts are stopping. There's still unpredictability in the market with, political issues, with, labor continuing to move. But what are you seeing the shift right now, or have you seen it yet?
We've seen a shift. There's definitely, I think, desire and a requirement to deploy capital. A lot of the institutional funds are paid to deploy capital. They're not paid to sit and watch the market. And so we're seeing that desire to deploy capital. I think the reality is still that it's very tough for them to get their arms around deals or to take the risk on deals, especially in a world where projects are costing a lot more than existing assets. And so if you're going to say, okay, we're predicting that there's going to be good rent growth in 2 years, well, you can either go and build something and deliver it in 2 or 3 years, or you can go buy something now and pay a market cap rate today and still be able to experience that same rent growth and without taking development risk. So That's the challenge. That's the challenge today for especially the opportunistic capital. We're seeing the opportunistic capital really hone in and try to deploy is in recapitalization situations where you either have projects that had cost overruns and need new money to come in. Either they're done or near completion, and you're buying out partners, or in situations where there may be a note buying opportunity. But we're seeing fewer note buying opportunities this cycle, and it's more just general recapitalizations that are necessary.
You think that we all keep waiting for that the opportunity to buy notes or to buy pools like last time, and I keep hearing the rumors of it, but it's like chasing the holy grail. The stuff that I've seen has been close to par, or it's been really broken, and it feels like kind of 08, 09, not 10 or 11 yet.
No, and I don't know that I'm not predicting that it gets to 10, 11. We've got a completely different market and completely different pressure points that are working through the system. I mean, fundamentally, we've got an economy that's still strong by all the metrics. So, we, to the extent we're seeing softness, it's really due to a supply-demand imbalance, which, given a little bit of time, that's going to get corrected. And from a lender's standpoint, we didn't see banks specifically get aggressive and lever up properties beyond 65. Rare instances you'd see 70% leverage loan to cost being funded. So those banks are in a good position in terms of their notes, which is why they're not seeking to take discounts. And flip side of that is that they're also not getting pressure. I'm not hearing that they're getting pressure from regulators to wholesale kind of get rid of their real estate exposure. So I think those primary factors, we're not seeing it. And the groups that were aggressive, the debt funds, they're a different animal. Oftentimes they're owned by investment firms or have an investment and ownership expertise within their organization. So rather than sell a note, they're able to foreclose or do a deed in lieu and take over the asset and manage it. And so we've not seen that market correction in terms of pricing that many expect. Here and there you're seeing like office and I'd say primarily office, where we've heard and have seen some notes trade at a discount, but office is got a different fundamental issue right now that the sector is going through. And other than that, again, we have not seen, and I don't anticipate that we're going to see significant discounts on at least the bank owned notes.
Yeah, it's interesting to bring that up because I agree with it. I don't know on the bank notes. You're closer to that than I am. I keep thinking it's going to come, or maybe I'm hoping it's going to come, but I can't argue with you on that. It's this round I do see is different. Office is structural. It was not just COVID related, but it was also cost related, TI related. A lot of the defaults we're seeing now from our side, it's really an inflation issue. You look at multifamily, great assets, great rents, but maybe the debt service coverage ratio is off. Or, you look in Austin, you look at Nashville. It's not that the fact that people aren't moving there; it's the fact that we overbuilt. There's 2 years of supply, and for us, we're starting to see our big family office clients lean in and buy in those markets and buy land. Not necessarily as LPs, but as GPs for generational hold, and they're getting back to the fundamentals because we've seen a 20-30% cost reduction in dirt. Are your families starting to want to get more active? I mean, they don't have a mandate to necessarily put money out, so they have options, but like where are they focusing now?
They don't, but they're seeing a moment in time and the opportunity to step in when the institutional capital is primarily sidelined. The REITs with their cost of capital and dividend yields can't necessarily go out and buy completed multifamily right now and achieve their yields. And the core funds are having their own liquidity issues right now with redemptions. So yeah, this definitely presents an opportunity for the families to come in and buy, newly built, recently stabilized properties in well-located markets that are going to grow over time. So yeah, we've definitely seen a shift there. One of our big investor family offices actually made that shift last year, and we were initially they were looking to develop in locations and markets, and they said, you know what, we would rather just buy right now, and they've gone out and have been actively acquiring.
So for developers, which are a lot of your clients, the juice for us is more in the the value add or the ground up versus buying some. There's not a lot of fees or promoting buying a brand new stabilized deal. Where do you see months for operators? Like where's the demand coming from on the equity side? Where is it still industrial, bay, self-storage, or what markets?
And I'd say the favored asset classes remain multifamily, industrial, self-storage, built for rent housing, manufactured housing to the extent you can build it. Markets, it's generally market agnostic. There's obviously you want to be in a market or a location where there isn't where there's an end to the supply, which is generally most markets. But I think the biggest challenge right now is trying to get to a yield on cost that would make it attractive. So we're generally hearing that they're targeting somewhere in the neighborhood of a 6.5 yield on cost. And as you know, where construction costs are today, in virtually every market, you need to get the land for free in order to make that pencil, or make use rents that are just not comparable. So, we looked at a deal recently in South Carolina, and, developer was building it to just north of a 6.5 yield on cost. And once we started getting into their numbers, we saw that they were using, first of all, they were building a product that didn't exist, a unit mix, a unit type that wasn't very prevalent in the market. And then on top of it, they were using rents that, to the extent you could comp the unit, it was 15-20% higher than what comparable properties were getting. So, those deals are just not going to get off the ground right now. The way,
what kind of spread was it? Was it you're saying that an untrended 6.5, so that they're thinking of 200 basis points?
Yeah. That I'd say generally right now we're we're seeing multifamily trade in the high 4s in certain instances, cap rates, all the way to kind of a 5.25. That seems to be the bandwidth of where multifamily is being priced relative to where treasuries are today. So, which is fine. I think that's it doesn't feel aggressive. It doesn't feel too conservative, but that kind of generally feels like a good place to buy. Even if it was a 5 cap location, you've got 150 basis points of spread there. So, I mean, that's usually enough on an untrended basis, and with some trending, you get to 200. But everything needs to compound and make sense.
Right. Well, and it's interesting. You and I have been through more than one cycle. So as we kind of look forward to it, as you're talking to people that are getting into your business, capital markets and such, what's your advice to them as they come up? Aside from getting to know people, as you look at kind of the art of the deal, to me, the next 12 to 18 months will be the new normal. Whatever will be, yeah. it will smooth out. So like how does someone new in the business create those relationships, or what are your teams targeting now? As you said, if you have to get the land for free, that's pretty tight. So like, what's the advice to somebody coming up in the business for cold calling or going after operators for business?
Look, I really think that we're going to be working on a lot of recapitalizations and refinances. I think sales activity is going to slow because, to the extent there isn't some sort of unrelated reason for a developer to sell, they're going to try and hold and maintain, because we're all in this market. We know how this works. In 2 years, all of a sudden we're going to see rent growth pop, and I think we've seen a good run up in expenses, and we're seeing expense growth moderate. So you're going to be in a better position to sell in a couple of years from a kind of a operations fundamental standpoint. So I think developers, to the extent their equity is not forcing them to sell, they're gonna try and recap and refinance. In certain instances, if equity is trying to sell, there may be an opportunity to bring in a new equity partner and kind of reset the business plan. In other instances, you just refinance the existing debt and try to return as much of the equity as possible, and sit on it for the next 3 years. So that's really I think the market opportunity. And we've been sourcing debt that's a little bit more flexible to allow sponsors to be able to do that. Especially, the life companies have some kind of hybrid bridge fixed rate products that will allow you to prepay after 3 years without significant prepayment penalties, which works really well. Otherwise, either the agencies or even CMBS has been very active. And in terms of kind of young people coming into the business, I think first and foremost is just align yourself with a good mentor. I think that's the key. That's how you're going to really learn the business and show up to the office. There's too many young people today that think that the norm is just working from home or working from wherever, whenever they feel like it. That's not how you develop skills and how you become a professional. I mean, you can probably make it by doing that, but I think ultimately in the long term, your growth is going to be stinted. So you're better off coming into the office, being a fly on the wall in meetings and calls and everything, and being there.
That's my next question is a little bit of a layup with you for that side, because I know you're technology minded and slanted, but at the same token, as AI comes into our business, we started out the conversation with you saying from George, the art of the deal and it's the art of the relationship. Yeah. And I couldn't agree with you more. I mean, we're big believers in AI, and for some of those out there that have gotten my spam emails, as we've learned our AI from our, as I already know you, and I'm, our CRM system is emailing you unabashedly just because we're figuring it out. But, relationships really do matter in this business, and, where tech can help and have that reach out, knowing the head of credit at a bank or doing multiple deals versus a borrower that's a one-off, it's years ago, when I used my first intermediary for debt, I went to a bank that I have a very large relationship with, and the broker was able to beat it by by 25 bips. And, they absolutely paid for themselves and got better terms. And so, and it offended me a little bit, but then I realized, okay, I'm going to that bank once. that person is going on a repeat basis every single day. And the reality is my relationship doesn't matter as much as a big fund or the intermediary. So it's like, how do you see that confluence of tech and relationship becoming a part of your business?
So I think I see tech as just an enabler, a way to make us more efficient. I don't see it as replacing the interplay and the conversation. There have been many firms that have tried over the years to just make it a tech platform, and I think both sides don't like it, because it's like, well, here, just upload your deal memo, your deal package into our system, and we'll blast it out. And then on the receiving end, you've got a human that's supposed to be working on it, and they don't know if it's a deal that's going to go to them, if it's a waste of time. There is a big human element to our business that isn't going to be disintermediated by tech. I think tech helps us become more efficient. So as you mentioned, like a CRM. So can my AI continuously learn and see how I'm creating my lender list, how I'm creating my equity list, what the feedback is, and give me a list of investors to go to on a deal? Yes, it'll get there. It's not there yet, but I think within the next 5 years, I'm sure our databases are going to be able to do that for us. Now, the next step, helping write a package, it can probably get us to a place where it will be able to take information we put into it and get a package to about 70%, but you still need that human element. I walked the property. I saw something there. I have to explain something in a certain way to make sure that it's not missed or it's understood in terms of the uniqueness of a location or the developer or the product type that's being built. And then it can probably send a canned email out. We generally don't blast. We're still kind of in the place where we take the 30 minutes we're sending it out to 30 people, make sure that, we kind of address it to that person. Again, I've got a relationship with the person. So it's like, hey, Colby, how you doing? It was great seeing you last week. Here's something that, a deal that I thought of you after we met. That doesn't work. And it's very evident when you get just an email blast, and it's off-putting personally. It's really tough to do business that way. So I think tech's going to make us more efficient. It's not going to replace the process. I mean, look, in certain segments of the market, it can, but in kind of maybe like a small loan, fixed rate, for a stabilized property that's cash flowing, maybe there's going to be something that takes over that business. But for a structured finance deal or an equity raise, I still expect that we're going to be using AI as an enabler, not as a replacement for what we all do.
It's funny. One of my mentors, Russ Bernard, used to always say, you can screw up great real estate with a bad operator, and you can make bad real estate a decent return with the best operator, and you need the blend. And it amazes me, to your original comment of for the younger generation, be in the office. And it's, to me, the best brokers, the best intermediaries create trust. And it's when you're sending a package out, people know that you've looked at it, that they believe your underwriting, that you've vetted it, that the sponsor, you've walked the property. And I completely agree with you. I mean, it's like, for us, people can do our job as project managers. The idea for us is we allow them to do other things. But I'm never not going to get on an airplane to go see a client or go see a property, because, if I'm mailing it in, then what's really my value? And when we see the next gen that wants to try to do things extremely remotely, it just, that's not our business. Our business is dirt and steel and concrete and wood, and you've got to figure out the drive patterns and the comps and everything else that's around you. And you can a desktop, but it doesn't replace seeing it with your own eyes on the ground.
Doesn't. I mean, you know, they often try to use like the Google Maps and kind of drive it on the screen. It's not the same. You have to go stand there, see what's happening on the street. You know, you're not going to see. Here's case in point. We're working on a project down in San Diego in a up and coming neighborhood. Very little development had happened there. It's a neighborhood called Golden Hill. And you look on a map and you see it's fine neighborhood, you know, see a lot of residential, but, you know, going and spending a morning there, going to the coffee shop, getting coffee and sitting and just looking at the street and seeing parents walking kids to school, which, you know, was, oh my God, like this is a family neighborhood. Because people were looking at the map and saying, okay, well, this neighborhood's right next to East Village. And had we not sat there and looked at it and then gone and driven East Village and seen the homelessness and extra, I'd say, stuff that was happening on the sidewalks there, you wouldn't be able to make the distinction because the two neighborhoods are literally separated by, you know, a quarter mile. And so you go there and you say, okay, this is a family neighborhood. This is a place where people want to live. This is a place where people are already living. There hasn't been housing built here for a significant amount of time. And now, you know, you've got an opportunity to invest here. And so that kind of fabric of the neighborhood, you'll never get from sitting and in front of a computer and trying to use Google Earth to drive the neighborhood.
Yeah, couldn't agree more. And it's you know, our business is exactly that, which is street corners, and it's you have to know the street corners. All right,
and I'd say reputationally, that's also, again, you mentioned it. You know, when our investors or lenders get a package from us, they focus on it. Why do they focus on it? Because they know that I've spent time on the asset, on the sponsor. We vetted it. We know what's going on. And if they spend time on it and they spend 5 minutes reading our package, they'll get the full picture and they'll be able to make a determination very quickly if it's a fit or not, and then jump on a phone with us and then have a conversation about, you know, how do we get the deal done?
So a little crystal ball from you. So, and I'd compare private equity versus family office world. So last summer, I won't name names, but I knew a lot of my private equity fund friends basically became single-digit handicap golfers and took the summer off, or were told to. This summer, you know, we're seeing 1 and 2 week trips, but a lot of focus. Next summer, you know, what are you seeing in volume flow? You know, as we said, you don't see a lot of development, a lot of sales, a lot of gap, but this last year to this year to next year, what's the prediction?
My prediction is that we're going to see equity come back into development next year. I think it's going to be a function of rent growth and fundamentals strengthening, combined with a lack of investment opportunities and a little bit more predictability on kind of the delivery and cost side of the development equation. So I think those three things are going to moderate development risk and make it attractive again. And we'll see some of the opportunistic capital go back to development. We've definitely seen a slowdown again this summer. It's not as bad as it was last summer. And I think the rest of the year, we're all going to be relatively busy working on recaps. There was a lot of investment made in 21 and 22. A lot of those loans are maturing now. And the vast majority of them are going to need some sort of infusion of capital, either equity or you know, new higher leverage debt to be able to continue or an exit. So, you know, I expect we'll see transaction volume pick up in the third quarter on on recaps and into early next year. And then by next summer, again, kind of getting back to a place where development's going to start being very attractive for a lot of folks.
So you and I are kind of unicorns. I mean, it's very rare for two guys to have come from engineering and construction and jump the shark and also understand, finance and equity. If you were to rewind and give advice to folks, what, would you have them go similar path, start in brokerage, start in on the analytics side, or start in PE, or as you're looking at a well-rounded developer or a sponsor you're looking for to represent, what path would you send the new young professional?
I always, have these conversations relatively frequently, and it's, you have, if they've got a 5 or 10 year game plan, if they want to be a developer, go work for a developer. Working in brokerage or finance isn't necessarily going to teach you the skills. I mean, you're going to get to meet people and build a network, but it won't teach you development and the intricacies of development. If you want to be a private equity or a finance person, or go, finance is a little bit easier. You have different roles within finance, whether it's working in investment banking, capital advisory, banking, on the equity, on the debt side. So there's a multitude of roles, and there in finance, again, I would just say, find that good, focus less on the name on the door, like the company, because the company is almost somewhat irrelevant. It's really the person that you're going to be working with and the type of exposure you're going to get. I just had a conversation actually with somebody I know who works in New York and was recently laid off, and he got a brokerage position with one of the large national brokerage teams. And he's been out of undergrad for about 3 years, I think 4 years almost, and had a variety of analyst and associate roles. And he's probably at a point where he's an associate, and they offered him an analyst role. And he asked me, should I take it? And I said, well, who are you going to be working for? What are they going to be having you do? And, are you going to be able to learn? And is there a chance for advancement? So if there is, then it doesn't really matter what title they give you. Go work, set the expectations correctly with them in terms of what you want and the type of experience you want to gain, and go in, put your head down, work, outshine everybody else for the next 6 months, and then have a conversation with them again in 6 months. And if you see that they're not going to give you the opportunity to advance and expose you to experiences that are more in line with your experience, then move on. If you see that they're advancing you and there's still room to grow and you're coming to the office and learning every day, then continue and you'll be in a good place. So it really doesn't, a lot of young folks focus a little bit too much on the name of the door or kind of what the starting pay is. Starting pay is irrelevant. As like 5-10 years down the road, it's not going to matter if you made another 10 or 20 or $50,000 your first year. It's really about the experience and kind of how that's going to allow you to kind of grow and launch you into your career.
I totally agree with you. And I think, I tell our younger folks, and especially people I interview, I said, it kind of depends what you want. To your point of, do you want to be a developer? Well, do you want to be entrepreneurial or do you want to be institutional? If you want to be institutional, go get an MBA, go get a master's of real estate, go to a pedigreed group that follows a specific path, but you're going to be locked into a path. If you want to be entrepreneurial, go find that shop and that mentor that's going to give you maximum exposure to deals, to every asset that they'll put, that will put you in their hip pocket and teach you what they learned. And if you figure that it costs you $200,000 to go get an MBA, well, if you said, all right, I'll take $50,000 less for 4 years, but I can make $1 million more after that, the ROI on that is far exceeds what it is. And if you find the right mentor, they'll plug you into their network. They'll plug you into conferences and conventions and introduce you around. No different than an MBA will.
Yeah,
But
and they might even partner with you down the road and help you launch your business. So I think it's really, you don't have to lock yourself in. You may wake up one day and say, hey, I want to be a little bit more entrepreneurial. Quite frankly, I never thought that I'd be running my own business. I always thought I'd be working in an environment that allowed me to be entrepreneurial, but not necessarily running my own company. But then I found it was necessary to do so. So I went out and did it. But at that point, I'd already had my own team and was working independently. So it wasn't as big of a leap to say, okay, oh my God, I'm going to start a company and what do? I already had a strong foundation, being able to generate business and close business on my own, and had a client base. So just, it's really more the apprehension to whether or not people are doing business with me or doing business with my company. And I quickly learned that it was really people are doing business with me. And the company name was secondary at that point.
Well, I'm glad you did. And for our listeners and viewers, please look up Shlomi at Dekel Capital for any debt and equity needs. And thank you again for your time today. And for all our viewers, continue to log in, listen in, like, and share us, follow CREDE, and play offense. So thank you, Shlomi. Appreciate your time.
Absolutely. Thanks, Colby.
Take care.
See you soon.